Before we begin, just a quick note. This podcast is produced by qualified financial professionals and is intended to share general information and insights to help expats better understand common financial topics. However, everyone's circumstances are different and regulations can vary by country, so nothing discussed should be taken as personal financial, tax, or investment advice. If you're considering making financial decisions based on anything covered in this episode, we recommend seeking professional advice tailored to your individual situation.
Hi, I'm Georgina, and you're listening to Expert Money Matters. At Chase Buchanan, we know your time is valuable, so we've taken our signature weekly market update email and turned it into this easy-to-digest audio briefing, so you can stay informed while you're on the move. Here is your weekly market update for the 27th of May, 2026.
Good morning or good afternoon, depending on where you are in the world. In last week's update, we looked at the countervailing forces investors were facing. Strong earnings momentum on one side and narrow market leadership. Retail investors' fear of missing out and geopolitical risk on the other. Since then, several of the key follow-up points have come into sharper focus. Recent UK data, global PMI readings, Middle East headlines, and oil price movements all point to a market environment that remains difficult to read and even harder to plan around. For expats, especially British expats living in Europe, this is not just about investment markets. It is about currency, income, pensions, tax, property, and the cost of living abroad. UK data. The question is what comes next. The UK data released over the past couple of weeks has left investors with a difficult question. Is the economy cooling in a manageable way, or are we seeing the early signs of a more uncomfortable slowdown? Inflation has eased from its March level, helped partly by the reduction in the household energy price cap. That gave markets some reassurance. However, the more important question now is whether that improvement can last if energy prices remain volatile and wider cost pressures continue to move through the economy. At the same time, the UK consumer looks under pressure. The latest retail sales figures showed a fall, reversing the previous month's gain, while fuel sales were notably weak. That suggests households are already responding to higher prices by cutting back. The labour market is also cooling, with unemployment rising and payroll numbers weakening. For the Bank of England, this creates a difficult balancing act. Softer consumer spending and a weaker labour market would normally support the case for lower interest rates. But if energy prices stay volatile and if inflation pressures rebuild, the bank may have less room to cut than markets would like. For British expats living in Europe, this matters because the interest rate outlook feeds directly into sterling. If markets become more confident that UK rates will fall, while the European Central Bank remains more cautious, sterling could come under pressure against the euro. That means the same UK pension, rental income, or investment withdrawal may buy less locally. Global growth, the PMI data, raised concerns. And last week we said the flash PMI readings would be important. They have now reinforced concerns that global growth is losing momentum. The latest figures suggest business activity across the major developed economies has slowed sharply. The uncomfortable part is that this slowdown is happening while input costs remain under pressure. That is the combination markets dislike. Weaker growth, but not enough comfort on inflation to allow central banks to relax fully. In other words, the risk of a stagflationary backdrop has not gone away. Middle East risk and oil remain key watch points. The other major follow-up from last week is the Middle East. We discussed the risk of renewed hostilities, US-Iran tensions, and the possible impact on energy facilities and oil prices. Since then, oil has remained highly sensitive to diplomatic headlines. There have been reports of possible progress towards reopening the Strait of Hormuz, which helped oil prices fall back from more extreme levels. But the situation remains fragile. If diplomacy holds, oil prices may calm further. If it fails, energy prices could move sharply higher again. For globally mobile families, oil volatility does not only affect investment markets, it can affect flight costs, fuel prices, shipping costs, imported goods, heating, cooling, and wider inflation. For British expats in Europe, that can create a double squeeze. Sterling income may weaken at the same time as euro-denominated living costs remain high. Equity markets still supported, but still narrow. Equity markets continue to tell a different story. US markets remain supported by earnings upgrades, particularly in technology and artificial intelligence. However, the concern we raised last week remains valid. The rally is still heavily concentrated. A relatively small number of companies continue to drive a large share of the gains. AI-related capital expenditure is feeding through parts of the supply chain and supporting earnings expectations. But if the market becomes too dependent on one theme, it also becomes more vulnerable if that theme disappoints. This is particularly important for expats with globally invested portfolios. Many people believe they are well diversified because they hold global equity funds, but global indices can still carry significant exposure to US technology and AI-linked companies. So the question is not simply whether a portfolio looks global. The question is, what is really driving the return? For American expats in Europe, the picture is slightly different. A strong US dollar can support spending power for those earning or drawing income in dollars while living in the Eurozone. But many American expats also hold portfolios heavily weighted towards US equities, which creates its own concentration risk if the rally remains dependent on a narrow group of technology stocks. For British expats, the bigger near-term issue is likely to be sterling pensions and cross-border planning. The latest public finance figures also came in weaker than expected, while public debt remains elevated. That matters because it limits the government's room for manoeuvre. When public finances are tight, the risk of future tax pressure increases, and for internationally mobile families, tax pressure rarely stays neatly inside one box. It can affect pensions, property, investment income, inheritance planning, and estate structuring. Local rules still matter. Country-specific planning remains essential. Spain remains complex because of regional differences in wealth tax and income tax. Portugal has moved away from the old non-habitual resident regime, with the newer incentive structure being much narrower. France continues to require careful planning around social charges, investment income, pensions, and real estate wealth. Italy remains attractive for some pensioners in specific regions, but the rules are precise and need careful checking. Cyprus and Malta continue to offer interesting structures for certain non-domiciled residents, but remittance rules, residency conditions and local compliance are critical. The point is simple. For British expats in Europe, the financial planning environment is becoming more fragmented, not less. Global markets matter, but local rules matter just as much, sometimes more. What internationally mobile families should review now. This is a good moment to review the areas where global market conditions and personal financial planning overlap. That includes currency exposure, especially if your income is in sterling, but your spending is in euros. It includes cash holdings, because holding emergency funds in the wrong currency can create unnecessary risk. It also includes pension withdrawal strategy, particularly where income, tax, residency, and currency needs all interact. Portfolio concentration should also be reviewed. A global portfolio may not be as diversified as it appears if it is mostly riding the same US technology and AI theme. Local tax residency is another key area. Rules in Spain, Portugal, France, Italy, Cyprus, and Malta can produce very different outcomes. Finally, estate planning should be reviewed carefully. A UK will. A UK pension, European property, and beneficiaries living in different countries can create a complicated picture. That picture needs to be joined up. What to watch next? Looking ahead, the key areas to watch are the next signals from the Bank of England, the European Central Bank and the Federal Reserve, the next UK inflation reading, whether oil prices continue to calm or spike again, whether the AI-led equity rally broadens out, and whether European governments introduce further tax or residency changes as they respond to their own fiscal pressures.
And that wraps up this week's Market Snapshot. If you'd prefer to get the information before it's published here, you can sign up for the update directly on our website. Just visit chasebuchanan.com and subscribe and get the update delivered straight to your inbox, giving you a head start on the week. Thanks for listening to Expert Money Matters. I'm Georgina. Join us next time as we explore money matters for your life abroad.